I'm Justin Boyd, President of Delta Financial Advisory, a registered investment advisor focusing on flexible, relative return strategies for mass affluent and high net worth investors. Welcome to our monthly market update for May 2025. With no shortage of data and high levels of volatility occurring in April, let's roll up our sleeves and get started. Please note, as with any of our videos, this content is intended for general informational and commentary purposes only, and none of this should be interpreted or construed as personalized financial or investment advice. Please refer to the conclusion of this video for a more detailed disclaimer. Throughout this video, if you do have further questions or concerns regarding your portfolio positioning in the current market landscape and think our approach here at Delta Financial Advisory may be a good fit for you, please reach out via the contact request form found on our website at deltafinancialadvisory.com. April finally presented patient investors with a real glimpse of the potential reward for disciplined asset allocation. Since the launch of this channel in the fourth quarter of 2024, we have remained steadfast on a few key items, particularly an underweight of equities and duration within our portfolios, as well as foregoing non-treasury fixed income due to historically low credit spreads. Instead, pursuing more attractive risk-adjusted returns via a conservative bias. Our underweighting of key factors provided us with the dry powder required to capitalize on the severe market decline that culminated on April 7th, where we were able to secure an entry tranche for our clients well below 5,000 on the S&P. Amidst volatility not seen since the Great Financial Crisis, we subsequently exited those positions on April 14th, with the S&P well above 5,400, securing an almost 12% gain for clients. As I mentioned before in this channel, we absolutely do not trade client accounts here at Delta Advisory and entered those positions with the full intention of achieving long-term capital gains and aligning with the marginal tax rate concerns that most of our clients have. However, sitting on a 12% gain in just a few days, and given the backdrop of the larger market landscape, we also don't allow tax considerations in isolation to drive our fundamental asset allocation. Moving on now to present circumstances and some of the things we're particularly watching to guide our asset allocation and investment strategy going forward. We'll start with the US dollar and current fiscal policy. While the US dollar may continue to experience erosion around the margin in terms of dominance as both a medium of exchange and reserve asset, we caution against sensational outlooks in the short term. From a quantitative short-term perspective, a test of long-term support around 96.50 on the Dixie seems quite reasonable. However, from our perspective, this would by no means suggest sustained or out-of-control capital flight from the US at this time. Recent Treasury and auction data support this viewpoint. We don't, however, view the current situation entirely through rose-colored glasses. U.S. fiscal policy remains on an unsustainable path, if not properly addressed, and this is inextricably linked with the U.S. dollar. Some nuance and outcomes should be expected based on the primary location within the yield curve where the net financing occurs, whether market-based or achieved through future QE. Our bottom line view is that current fiscal dominance provides a consistent inflationary pressure that requires longer-term planning by capital allocators. For viewers who may be interested in further analysis of the U.S. fiscal situation, we also have a previously published and robust video on the topic here on our channel. The third critical input driving our approach in the intermediate term are current earnings per share estimates. It's important to acknowledge that earnings have been robust, driven by concentrated weightings in big tech and monstrous share buyback programs, with S&P earnings growing at approximately 13% for Q1 2025 and 2026 estimates around 14% for the year. Assuming all positive future outcomes, a generally aggressive market participant could extrapolate this over a longer time horizon and arrive essentially where the market is trading today. In fact, higher prices could even be rationalized from here. Our concerns arise from the generally aggressive assumptions that are seemingly priced in for all consensus inputs, to include growth rates, operating margins, and valuation multiples. While we never entirely discount the possibility of any input or scenario, we remain skeptical of the likelihood of this combination of inputs actually materializing. Assuming somewhat more modest, but still reasonably generous longer-term assumptions, such as a 10% earnings per share growth rate, and merely reducing an investor's annualized return expectation back in line with longer-term averages, we view current market pricing near the top end of even a reasonably aggressive range. Could the market continue to run up? Absolutely. We have noted in prior updates that liquidity remains reasonably supportive, with total commercial lending and overall M2 marginally increasing as the months go by. However, utilizing our disciplined approach to long-term asset allocation, we find it increasingly difficult to justify full weight equity exposure as relative measures of equity pricing quickly return to materially elevated levels. As we move toward wrapping up this month, I'd like to make several specific mentions that we think should remain on investors' radar. After 49 months averaging 4% or greater, national rental cost increases finally fell below 4% on a year-over-year basis in the latest CPI report. This decline is gravitating toward more real-time measures of rental inflation we have discussed on several occasions here recently. Should this trend continue, simply due to the large weighting in the inflation indexes, lower inflation numbers could receive a tailwind for the time being at the headline level. Additionally, overall inflation pressures have eased, as evidenced by the sticky price index, less food, energy, and shelter, where the most recent print came in at 2.2% on a year-over-year basis, which is closely in line with the core PCE year-over-year increase of 2.6%. Two interesting side notes here. First, core PCE on a quarterly basis increased about 3.5% in the most recent release, in conjunction with significant movement within the GDP numbers. The next few quarters will tell if this surge in activity was simply tariff front-running, or in fact was the seeds of further inflationary pressures, or perhaps the initial signs of additional economic growth. Second, it deserves mentioning that while tariffs certainly could slow economic growth, there has been evidence already of significant capital investment coming to the United States as a direct result of the tariff agenda, which increases GDP point in time, but more importantly, creates sustainable growth in the future. Some high-profile names outside of tech include Johnson & Johnson, Hyundai, Eli Lilly, and Chobani, to name a few. Although not specifically broken out in the GDP data, the beginning of this broad trend was very possibly evidenced by the large 22.5% quarterly increase in equipment investment, likely by existing domestic producers expressing confidence in the passage of targeted depreciation incentives, as well as general tariff avoidance. There has also been significant focus of late on the basis trade, a generic description for large, leveraged, non-primary dealer treasury market participants. We do view the recent focus as warranted, and the changing composition of the largest treasury market holders should be noted, as at a minimum, it adds increased risk to pricing and volatility to the market. We think fixed income investors should certainly keep this in mind when evaluating volatility and real returns within their fixed income allocations. Last but not least, the International Monetary Fund came out with a fairly downbeat report with primary highlights that included elevated equity valuations, institutional strains within the financial markets, as well as the possibility of further turbulence in the sovereign debt markets, as we just discussed. I'll leave any more of the colorful reading to the viewer, but suffice to say, we agree with this report and would also note specific mention was made to providing liquidity for non-banks with, quote, appropriate guardrails. We have an entire video here in this channel entitled Private Credit, an Overlooked Systemic Risk, published back on January 1st of this year. If you'd like more information on the systemic risks of non-banks, I'd encourage you to watch that video. The possible outcomes in today's financial landscape remain very wide. Liquidity is increasing, and the current administration has specifically made recapitalizing the private sector a priority, which aligns nicely in terms of timing with the upcoming private market debt refinancing needs of the next few years. Alternatively, the Fed remains insistent they will not lower rates without considerable reason, and data continues to be mixed. Further, one of the frontrunners for the Fed chairman position in 2026 appears to be openly critical of past quantitative easing, and some might even label him openly hawkish in certain respects. Despite the window of opportunity provided and taken for double-digit gains on a portion of our portfolios in April, we ultimately finished the month with a similar asset allocation as we began the month. We remain biased toward a capital preservation stance at this time, with a continued moderate underweight of equity and duration. In the fixed income universe, we were able to identify green shoots of opportunity in select BBB issuances amidst the volatility of April as credit spreads began to genuinely widen. While we would classify these positions as simply dipping our toes in the water, we did find it noteworthy to mention as we have explicitly avoided non-treasury debt to this point. A main point we'd leave viewers with is that flexibility remains as critical as ever. And that's how we approach our asset allocation strategies and client portfolio construction. Our approach always places our fiduciary duty to clients as the highest priority. A good portion of our clients have already accumulated the bulk of their wealth and engage with us for a trusted relationship where they can count on prudent and seasoned management of their capital, placing purchasing power preservation and tax efficiency high on the overall list of priorities. As always, if you'd like to learn more, please visit our website and complete the contact request form, and we'll reach out to schedule a complimentary consultation to determine if Delta Financial Advisory may be a good fit for you. We wish everyone health, happiness, and successful investing.
The information and commentary contained in this video are for general informational purposes only and do not constitute financial, investment, or other professional advice. Always consult with a qualified financial advisor before making any investment decisions. Investments carry risks, including the potential loss of principal. The content is based on current market conditions and is subject to change without notice. The firm is not responsible for any errors or omissions, or for any actions taken based on this information. Past performance is not indicative of future results. This material does not constitute an offer or solicitation to buy or sell any securities.